All right, good evening, guys. Ken, Tortoise Capital. This is Foundation's check-in for February 25th. So I had some questions on swing trading earlier this week. So I thought what I would do is give a quick summary of the mechanical swings and put them into context. So there are really two styles of trading for swing trades that I think of. One of them is the mechanical systems trading, and that's the ones I'm going to show right now. These are swing systems that have been back tested and forward tested quite a bit. Um, they can be robo traded, they are codable and can be traded automatically. And that's why they are a system, because they do have very explicit rules. When I talk about swing strategies, what I'm talking about is a more relaxed approach to swing trading, which takes a general approach, but gives the trader more flexibility, more options. What you see me doing with the hybrid swing trading or swing trading one day at a time is very much a strategy in that I have flexibility in adopting a trade frame that makes sense to me, and then I make essentially a rule for that trade, but I'm not following it in a mechanical way day in and day out. I'm using some discretion. So I wanted to just draw that distinction. So these are 6 mechanical systems that you have access to in the foundations course with the explicit rule sets. And so this is just an overview of those. Um, I, trying to get my pen to work here. There we go. All right, so the 6 systems. The first one is overreaction. The second one is channeling. The third one is 5 days down. Then there's 551W. There is the washout. And there is the triple screen. Now, each one of these has an optional add-on rule called the continuation pattern. Which I want you to think of as a module, which says, if I had one of these trades and it worked, and then I exited in the usual spot, and then if instead of going all the way back, it resumed a positive direction after I've exited, then the continuation pattern is how you can re-enter. And so that's really an add-on module. It looks very much like the Kata 2, and that's where the Kata 2 actually comes from, is that idea. Okay. So the first one is the overreaction. Now, the idea of the overreaction is that we have a strong trend greater than the 200-day moving average, so price greater than the 200-day moving average. And if we put a 10-period moving average on that as the boundary of normal, what we have in the overreaction is that some news event happens and price ends up dropping down to this location and closes at a certain distance, right? And what we're looking for on that is a sell-off. What we're looking for is a sell-off of 1 ATR. That the overreaction because of that news event moved it from the last close at least 1 ATR below the 10 period moving average. Okay. And we want all of the price, all price today is below the 10-day moving average. So what that means is that there was an overnight shock because of the news. And that caused a massive gap down right from the open. So we're not looking for something that during the day a news event occurred and then price during the day moved all the way down. What we're looking for is a shock that caused it to gap down, and then the close remained low. It remained 1 ATR below that 10 period moving average. When that happens, so price greater than the 200 and this kind of overreaction sell-off, then mechanically we buy the open tomorrow and we're going to use a 5% trail. And then the exit, you'll see here in a second, but you can leave the trailing stop on. So that's the main idea behind overreaction. Now, for the mechanical version of this system, we have only traded it on when we are using the overreaction system, we only use it on the main indexes, and there's a list of about 9 of those. And it only trades long, and it required, as I said, a significant short-term move away from the trend. And the idea is that we are going to make a short-term trend betting that this sell-off was an overreaction against the news, and that all the people that were buying and owning it on the way up on this strong upward trend are going to see that as a buy on dip opportunity. They're going to rush in and buy it, and that's going to drive the price back up to what was the previous trend, and it'll play catch up. It'll be a rapid repricing. Okay. So these are the keys that we have to have. The concepts that are involved, we need an ATR percentage to define a significant move. We're going to use the 10 period moving average as the long-term trend. The 10-day moving average is the short-term trend. We're going to require a volatile move away from the short-term trend. And then we're going to play a snapback to the short-term trend, which then probably will overcorrect back. So the overreaction occurs this way, the overcorrection comes this way and a little bit more. That's the main idea. When we first back tested and then forward tested this thing, we were in this period. It remains true. Back tested on it. This is semiconductors. It made money in both bull and bear. It's simple to trade, easy to learn. It's a mechanical system. It's a consistent money maker. It outperformed buy and hold. and it only takes a few simple rules, 5 minutes a day to work, and it's based on statistical back testing that and the typical behavior of volatility. And the concept is that the market corrects after a significant overreaction away from a strong positive trend. The rule set, as I just said, today's close greater than the 200-day. Today's high was less than the 10-day moving average. So if the 10-day moving average was here, and then the gap down occurs and the sell-off occurs, and that's the daily bar, you can see that the daily high, all of the price action is on the wrong side of the 10-day moving average. Right? So it didn't start here and then cross down. No, it gapped down and then sold off all day. It's more than 1/8. The close is more than 1 ATR percent below the 10-period moving average. We buy tomorrow's opening. You can buy a second position if the next day the trade conditions continue. And it exits at today's close. So you're on the day it closes is the day when yesterday closed back above the 10-day moving average. So let me say that again. So the 10-period moving average is like this. And then here was the setup day where you had that sharp move against it. So you buy the next day's open. And then as this thing goes up, once it corrects, and then today the close was above the 10-period moving average, you sell tomorrow's close. So you give it one more intraday move and then sell the close. And we're using ATR 14 for the ATR percentage. This is one where you can actually play it the other way. It's symmetrical. So if you had something where prices below the 200-day moving average, and then there was a dead cat bounce up, it is symmetrical. So I'm not going to dwell on that. The beauty of the system, it's about 70 to 80% accurate historically. You don't need to monitor it all day. You can trade it in both directions. Your cash is freed up when it's not being invoked. And you can tell right from the open if you're going to have that kind of a day. Because if it didn't gap down below the 10, you know that it's not a setup day. So so you're not, you can use that cash for other positions. Let me say it that way. Requires no discretionary judgment. It lets you remain calm. There's a high percentage of winning trades. We're going to use it in a basket of ETFs. Keep it simple. Paper trade until you're comfortable. Trade small position sizes. I'm going to show you on the main report now where you find that. Let's see. On the first page of the daily report every day. Sorry, I should have had this open. So when you look on the daily report, on the very first page. We have the overreaction system here, and the mechanical system trades on those ETFs. So the S&P 500, the NASDAQ 100, the Dow 30, the Russell mid caps, Russell small caps, Euro Asia blend, Asia less Japan, Latin America, emerging markets, and the European 350. And so it has only these three rules. Today's close had to be greater than the 200-day moving average, and you can see that all of them meet the first rule. Then the daily high has to be below the 10-day moving average. So if the 10-day moving average is here, then, and if this was the bar, the high of the day, which is right here, has to be below the 10-period moving average. All right. So that's what I mean by all of the price level has to be below the 10. And finally, rule number 3, the close has to be less than the long trigger. And that means that this close has to be 1 ATR below the 10-period moving average. So the high doesn't have to be, but the close, there has to be at least 1 ATR from the 10-period moving average. That's the middle of the dragon versus the close. Does that answer your question, Alex?
Sorry, unmuting. So the high should be over the day is below 10-day moving average, but
Yeah.
But the closing is below the 1 ATR of the moving average. Okay,
Exactly.
So that's got it.
So remember, this thing had been going up, and then there was a gap down, and then at the close to evaluate it, you say, look, the high of the day had to be below the 10. It could be close, but it has to be below the 10-period moving average. That means that there was a significant sell-off all day. And then the second check, so there has to be some gap in here, right? And then the close has to be 1 ATR away. That gives you enough room to make the move tomorrow.
Got it. Thank you.
Yeah, so if it opened above and was up in here, and then there was a news event during the day, and then it closed way down here, yeah, the close is more than 1 ATR, but it crossed the 10 period. We want all of that price action to have been like this. Has to be on the wrong side of the 10. Okay.
Got it. So the gap first, then selling off. Yeah.
Yeah. Yeah. I see Jay says, looks like the RL 10, 30, and 90 on the SPX are pinched on a 6-month. Yeah. Yeah, they are all outrageously high. That's correct. All right, so that's what the rules on the long side are. These are the same rules, but on the short side, they are mirror image. And then what I do, and it's the same set of symbols. Okay. And then if all three of these signals fired, yes, yes, and yes, then that symbol turns green. Now, the reason I have this right in the middle of page 1, and I look at it every day, is because both the channeling and the overreaction systems, which are conservative, purely mechanical systems for the larger indexes, these things are anywhere from 70 to 85% favorable every year. You know, the number will vary each year, but these have been positive expectancy every year since 2005. So they don't fire all that often, but when they do, I really pay attention because it tells you that there's a 70 to 85% chance of an upward moving trend over the next 3 or 4 days. So I pay attention to those. All right, so that's the overreaction. The next one we're going to do is look at the channeling rule. And this one's even easier. There's only 2 rules. The first one is that the close has to be greater than the 200-day moving average. And the Williams percent R 10 is oversold, less than minus 80. Those are the only 2 rules. So what that looks like in practice was it was up, and then there was a pullback of some measure. And when you look at the 10-period moving average, you have minus 80 is the signal for oversold, excuse me. OS, oversold. So this is the red zone. And then the positive zone is minus 20 or above. So it goes from 0 to 100. So what we're looking for is price has been moving up, and then it has drifted down into oversold conditions. So it has drifted down into oversold. And price is greater than the 200-day moving average. When that happens, you buy tomorrow's open. And then you hold it until that same Williams percent R has now rolled back up to minus 30. We're going to take that as a recovery, the recovery move. Okay. So all you're doing is you're buying it officially on a dip. This one is also 70 to 85% winning trades year in and year out. The difference between channeling and overreaction is that overreaction requires a sharp adverse move. Channeling just needs to see it in the oversold condition. So if you have the case where let me throw that. Yeah, so if you had the case where here's the 10-period moving average and price was just kind of moving up, and then all of a sudden there was the news event like a Fed, and it came all the way down here and got oversold. Well, because the high of the day was above the 10-period, overreaction would not fire. But if it was that far oversold, then channeling would pick it up. If there was a big gap down and a sell-off, then both channeling and overreaction can fire on the same symbols each day, but they don't always have to. Okay. So both of those are very reliable, infrequent, but reliable signals. What I like to use them for is as an indicator about the current condition of these big indexes, especially the US indexes. So if I'm trading a bunch of large cap stocks that are strongly correlated to the S&P 500 or the NASDAQ or the Russell, and all of a sudden the S&P gets oversold, and I know that there's a good chance for a 3 to 5 day recovery, that can cause me to take a look at my favorite large cap stocks and be ready to trade them as soon as I see the S&P go up. So you can use these as trading systems, but you can also use them as filters or alerts for trading other symbols more aggressively. Because what we believe is that the market is worth 50%, sectors are worth 25%, and the company itself is worth 25%. So if I can get the market call right, that's why I put this on page 1 of my report, so I can see if tomorrow there's any expectation of favorable bumps. Okay. Any questions on that?
Thank you.
Okay.
So you're using as an indicator, you're waiting for this big indexes to start reversing.
Well, I can trade other symbols without these firing, but if the market itself is firing, then it makes me pay attention even more to swing trades the next day in the other symbols, because it gives you extra horsepower when the market is moving hard.
And this,
All right. So that's what the channeling essentially gives you, that same information. Okay. All right, this one, the 5 days down, this one's probably my favorite. And so the story behind this one is it references some research that Larry Connors had done back in the internet bubble years, really. And he tested it from 1970 forward, and we tested it from 1996 to 2006 exhaustively. And what we did was we looked at all Dow 30 symbols and all 500 members of the S&P 500 and 100 NASDAQ symbols and about 500 exchange traded funds. And we tested them in all kinds of markets. And we tested them every day for that 11-year period. And what we looked at was Connors found that that like 5 days down had a window of improvement of expected returns, especially good if you held it for 4 days or 5 days. There was a smaller bump after 3 days, and that bump lasted as long as 6 days. But the sweet spot for Connors' work was that if you look for 5 lower closes, so now that's the pattern. So if this is the close on the 0 day, day 1, 2, 3, 4, 5, lower close 1, 2, 3, 4, 5. 5 lower closes. That triggered a 5-day down. And on his research, you had a favorable window from 3 to 6 days. Well, what we did was we took a look at all that, about 1,000 symbols, and for every day that was down 1 day, we said, what happens if you held all those trades just 1 day and sold it at the close 1 day? So we were looking at the close to close performance? And then what if you, for every symbol in that 10-year, 11-year period, if it was down one day, what was the value of holding it 1 day, 2 days, 3 days, 4, 5, 6, 7, 8, 9, 10, all the way down to 10 days? We found every case where we had 10 lower closes. And what if you what if you bought them the next day at the open and sold it at the close for 1 day, and then 2 days, 3 days, 4, all the way out to 10? And when you do all of that math, what we found was that there was, in fact, a statistically significant sweet spot that looked like this, that starting with 3 days down and holding 3, 4, 5, or 6 days, there was a slight but measurable advantage as the market recovered. Like, the idea is something like that was probably an overreaction, and that you could expect a retracement to get back to fair value somewhere. And then on 4 days down, we noticed that there was an even bigger payoff on 4 days and 5 days. And then on 5 days, what we found was, here was the sweet spot, was either 4 or 5 days down, and then holding them either 4 or 5 days gave you the biggest consistent price improvement out of that whole data set. And then this was the area, the area one step outside that was, there was still an advantage, just not as big as the one holding, 4 or 5 days down and then holding 4 or 5 days. So we just called that one the 5-day down. And we know that our edge is right in this area. And it's a persistent edge because the nearest neighbors are also working. When you get out fewer days down or too many days down, it turns out that these things were bad for a really good reason, and there was no rebound that was measurably reliable. And so once they're down 7 days in a row, they just suck. And the 1 and 2 days down, there was not enough difference in the performance to justify that as a setup. But the 3, 4, 5, and 6, for those little windows of time in here, there was a nice payoff. Check or hold? Okay. 551W. This came out of a lunchtime conversation with Leo Willert, who is the CEO of a Austrian hedge fund company, or I'm sorry, Austrian mutual fund company that had about $10 billion under management, and he's been a long-term client. And at lunchtime, he came up to me, and we had been talking about swing trading, and he said to me, Ken, I know that you like things that have been up for 5 weeks. There was a long-term mutual fund switching system that I had, that if everything was favorable, you could buy it, and as long as, compared to 5 weeks ago, today's price was greater than it was 5 weeks ago. So you had 5 weeks of price improvement. So we knew that was good. And we knew from the swing trade I just briefed you that a 5-day down pattern is also favorable. And we both liked the idea that if today was a white candle, so in other words, it opened here and closed here, that tomorrow, if it breaks out above the high, then that's going to be second day momentum. So this is day one, first day. And then the second day it's not unusual to see another white candle. So second day momentum. So we said, well, what if we put all those things together? If we added a universal entry, and we said that that the Williams percent R over the last 10 days was below -50. So if it's below -50, then there's a chance that the next couple days it could be going back to oversold. So we were not as strict on that as in other systems. So we just wanted to be on the correct side of value, below the midpoint. So we put all 5 of those rules together, and we came up with a pattern called the 551W, and the rules look like this. We did this kind of this was at Stock Charts, I think. So pick all of those large cap stocks and ETF 100. So it had to be very liquid. We said a measure of liquidity was they had to be trading at least 1 million shares. And the price had to be greater than 10, so you weren't buying low price things. You want to buy big fat things. And then we said today's close is greater than the weekly close 5 weeks ago. So in other words, price 5 weeks ago and the closing price today, it had to be higher than it was 5 weeks ago. Check or hold?
Check.
And the next rule was the daily close for yesterday. In other words, the day that it closed, when today is over, that's the day -1. So the daily close had to be lower than it was 5 days ago. So if I go back 1, 2, 3, 4, 5 days, it had to close here higher than today's close. So that's the sell-off. Now, it doesn't have to be 5 closes in a row. All it has to do is it has to be below the close 5 days ago, so that's the retracement. That's the pullback. And then we said today's open is less than today's close, meaning it had to be a white candle. So intraday, it opens here and closes there. So you have an intraday positive move. And then we said the final setup was the daily percent R has to be less than -50. And that means if we look down at Williams percent R, that's -50 is the midpoint, because today, maybe it closes here, that'd be about -70. So it has to be below -50. And what that means is to get back to the 10-day high, there's still a favorable move. If my risk would be something like that, I'm going to have a chance to get a reasonable recovery. So the recovery hasn't happened yet, is what we're saying. So that's a conceptual setup. And we do a little thought experiment in the old workshop that we used to run on this. Said, hey, just based on those words, draw a concept diagram using a framing structure. And you've already seen me draw that frame. It looks, if I did my concept diagram like that, it would end up looking like this. So the first thing that I have to do is, you know, this is today's, oops. This is today's candle. So it's a white candle, so it opens here and closes there. So it was an up day. And then if I go back 1, 2, 3, 4, 5 days ago, the close 5 days ago is higher than today's close. So that's a check. That's the retracement. That's the buy on dip. So 5 weeks ago, the close was here. And you can see it's up. And then there's the pullback. But the close today is still greater than the close 5 weeks ago. So I still have a positive move. But there was a 5-day, it's lower than the close 5 days ago. And today was 1 day up. And when it's if it's less than minus 50 on Williams percent R, and if I use that daily frame as my risk, then I still have room to get back for a favorable move. So that's a concept diagram.
So the difference between this and a 5 days down, in 5 days down has to be 5 consecutive days down.
Yes,
This
correct.
just needs to be down in any
On the
shape or
net, yeah, net to net. And one of the things that we saw was that sometimes you might get a, we noticed that you might get 3 days down, 1 day up, and then 2 more days down. So you never got that. If I had this, and those are all my closes. Because of that one anomaly, I don't get a 5DD. So I have to, because I have 1, 2, up, that's broken. Then I have to go 1, 2. So I'm only on a 2DD, but it might have been the case that this from close to close, that might be a significant sell-off that people are going to look at this as a buy on dip opportunity, and up it goes. Well, the 5DD never got that. So this was a more relaxed approach to simply saying, hey, there was a significant enough sell-off that it might be attractive to the buyers. Now, what made it more attractive is that the close to the close 5 weeks ago was positive. So this still has good feelings, right? Still has good feelings. Whereas a pure 5DD, that thing might be below the 200-day moving average and everything is horrible. It just needs 5 days down in a row. And 5 weeks ago, it could have been way up here. And this thing is just terrible. Or it could have been way down here and it could have been great and then had 5D. So the 5DD doesn't care. What the 5DD triggers on is the unusual behavior of 5 days down in a row is probably wrong, right? And that somebody's going to see that and say, well, let's just buy it. This one is like a buy on dip opportunity. It was strong. It sold off compared to 5 days ago. Today was a white candle. So there's intraday momentum. And so we're buying the second day's momentum on this one. The way we execute that is we set up the trade frame to buy 5 cents above yesterday's high with a stop 5 cents below the low. So we want to see an orderly opening inside of that white candle, and then we want to see it go through our opening or the entry, so we can buy this and then use that as a trailing stop, aiming for the 5-day high and then the 10-day high as targets to the upside. Okay. So this is a relaxed buy on dip opportunity. And as I said, you can download the written symbols or the written systems on this in the foundations course. All right, now the washout. Now this one was interesting. This one is one that I designed in the back of one of Dr. Tharp's workshops when he was up front talking about how important beliefs were. I remember it plain as day. And so the idea of this, it started off just as a thought experiment. And then I started off with the idea of, I should write a book on this one. I think I will. What if everything you knew was wrong? And I remember President Harry Truman's comment, that's Harry Truman. It's not what you don't know, it's what you know that ain't so, which he borrowed from Mark Twain in one form. And beliefs, what he's saying there is that beliefs can be so strong that it prevents you from seeing, like you're on this side and the truth is over here, but you can't see the truth because your beliefs get in the way. So this idea was, what if everything that I knew was wrong? Or said another way, what if everything the market wizards believed is wrong? So I started with what I thought was a reasonable set of market beliefs of conventional wisdom. The conventional wisdom says you should ride the trend in the strongest sectors with the strongest stocks. You shouldn't try to pick bottoms because you can't. And you should buy them when there's blood in the street, when everybody else hates them. And you should have the courage of your convictions and stay with it. And that you should trade small caps because small caps have an outperformance factor over the large caps because they're smaller and agile. So I said, well, let me take exactly the opposite of every one of those conventional beliefs. And you can find a lot of words written to affirm those as market beliefs. So I said, well, if I took exactly the opposite, I would try to avoid the trend and aim at the weakest sectors and the weakest stocks. I should try to pick the bottom. And now the opposite of hate is not love, but buy them when no one cares, when the volatility goes down. And then be afraid of your convictions. Don't believe in your trade setup and be ready to cut and run fast. And then focus on large cap stocks. So I said, what would that look like? What would that look like as a trading system? This would be the concept. Buy large cap, weak stocks when nobody cares. So they're not going up very strong and they're not selling off any further, but they've come to a momentary pause. And you'll be buying them. The idea is that you'll be buying them when everyone who was going to sell has sold and there's nobody left to sell. And when there is some price evidence of short-term improvement to counteract the hate that people have had for them, and you want to buy them when the market is going up, but you can also buy them when they're going up, even if the market is going down, because they're going up and have relative strength. You should plan for the recent swing high, always frame with a 2-to-1 reward to risk. When you see any hesitation in price, you should exit. And then you should watch for signs of institutional interest. Here's the idea. When everyone else who was going to sell has sold, what does that mean? Let's turn that into an operational definition. We're going to focus on large cap stocks, the S&P 100. They're going to be oversold on an annual basis. So that's like the last 12 months, these things are and this is Williams percent R, 260. That's 1 year. So the annual Williams percent R has to be oversold. And the short-term Williams percent R has to be oversold. So it's also down here on a 10-day basis. And that means the idea there is that if this thing has been oversold compared to the last 12 months, then every long-term buy and holder who could be persuaded to sell it has probably sold it. So there's nobody in that population left to sell. And if you had guys that were trying to buy the dip, but it's also still oversold on 10 period, then they've probably bailed out on it too. So both long-term and short-term sellers have sold. Now, what does price improvement mean? Price pattern looks like this. Well, we're going to think of the big sell as all of the selling of the last year and the last 10 days that caused this thing to be oversold on an annual and a 10-day basis. I just have that represented as the big sell. And this is the last day of that big sell. And that little price right there is the swing low. The setup day has to have three qualities. It has to have a higher low. So when I look at this one, I say the low today of the setup day has to be higher than the low of the swing low day. So that's the first piece of price improvement. It made a higher low. Check or hold?
Check.
Then it has to be a white candle that the open and the close. So close has to be greater than the open. And then today's close has to be greater than yesterday's high. That's this blue button. So here's yesterday's high. It has to close at a price that was greater than it ever even achieved the day before. Check or hold?
Check.
So if I detected that today was a setup day, then tomorrow could be an entry day if I see price while it's live breaks higher than the setup day's high, and it has not made a new low. So this is a live bar, and you'll notice that that looks like an universal entry because it opened inside yesterday's candle, and then it took out yesterday's high, and then you get an entry on that day. Okay, so that's what it takes to find it, to set up, and then to have an entry. Now, what happens on this thing is that typically you will have seen that great big long sell, and then there might have been a recent swing high, let's call that the 10-day high. And then this was the final selling pressure that made this one the swing low. And that was the filter day that was on the 260, it was oversold, and on the 10-day, it was oversold. And then here was the setup day. Higher low. This close was higher than that day's high. And it was a white candle. That makes this an entry day, and it broke out above the high of the setup day. Now, what I like to do on this is typically either use one ATR stop or just go down to the swing low and use that whole thing as the risk. I actually prefer just one ATR. And then I just trail it with one ATR. When I go back and I see the swing high, I look at that as a reasonable profit target in case this thing starts to stall. Then it's stalling at the same place it stalled before, so I'm quick to exit. But this is also the place where if institutional money takes an interest of buying a quality stock on sale after a huge sell-off, if this thing gets all the way back to the previous swing high and then continues to go, I'm going to take that as institutional money coming in, and I'll be ready to start trading that with COTA 2s all the way up. So we don't believe in this thing. If this thing starts failing right away, we just get out, and we're actually looking for a collapsing dragon. So in some ways, this was an anticipation 25 years ago of what ended up becoming the supported spring crossing under slightly different circumstances. Now, it turns out that the washout pattern, we were trading this thing during a bear and a sideways market. So the market was getting absolutely obliterated. And we were still trying to pick bottoms and go long on the weakest stocks while the market was in bear and sideways markets. And what we got was extraordinary. We got system quality numbers of 4.5. We had 57 winners, 34 losers. We had very strict risk control, and we had positive expectancy between -1 and +2, and we had some fat right tails. And we gained 100 R on 90 trades. That was pretty good. Now, when we traded it only in a bull market from 2006 to 2007, it was better. It was like a system quality number of 5.6. We gained 71 R each year. So it had a better score in the bull market, but even in a bear and a sideways market, we discovered that it was really good. So that was living proof to me that beliefs should be questioned and that you shouldn't even try to have too many beliefs. You should instead search for evidence, because you find out that that's more important than having a belief. And then use evidence to confirm ideas, and then to design rules around evidence, and then learn from the evidence as you continue to get it. So the washout pattern to me was a really important moment. The final one I want to talk about is Alexander Elder's. He's the great Alexander Elder from Trade for a Living. And this is my variation on his brilliant system, which he called the triple screen. Now, what he did on his triple screen was he was looking at 3 time frames. If you wanted to trade primarily on a daily, he said you should go up 1 time frame and look at the weekly to find a very strong trend. You should look for a pullback on the daily, and then on the hourly, you should look for an hourly breakout, and use that as evidence that this thing was starting to reverse by going intraday and looking for that kind of higher low and then a breakout. And that was I think that was the primary source of motivation for me to talk about that universal entry. It needs that higher low. So that was the triple screen idea from Dr. Elder. You needed a really strong weekly trend up, a weak daily trend like pull. That might even be like a 5DD or a channeling. And then you look for evidence on the shorter time frame that the reversion back to the stronger move up is starting to happen. So you're trying to be the second mouse, if I can say it that way. And that his book from 1993 is still great. That's 30 years ago. It combines 3 different time frames. It uses both trend following for long-term strong trends. It uses oscillating indicators for the intermediate term to get the pullback. And then it uses the breakout to get evidence of a continuation of the long-term trend. So what he suggested was a couple different ways that it could be traded. Like the one I use is I want to primarily trade with daily charts. So on screen 1, I go up to weekly. And then when it comes to breakouts, I go down to hourly. So you have a weekly, daily, hourly. He says you could also go up one full time frame and use weekly charts as your primary, move up to monthly to check for the long-term strong trend, and then drill down to daily breakouts. I just at my age, I want to trade more frequently than that. So I use the weekly, daily, hourly, as opposed to monthly, weekly, daily. Same principle. So what you would do first is on screen 1, the long term, you're looking for a strong trend. That's the type of trend you want. And so if I was using weekly, one way to find a strong weekly trend is to say weekly ADX greater than 25. It turns out that that daily ADX greater than 25 is also a strong trend. So one of the ways that we simplified our system was instead of scanning on weekly, we just said, let's pick a reading on ADX 25 that is on a daily so strong that if you went up to the weekly chart, you would see a strong uptrend. So we just stay on the daily and we look for a pullback below the 20 period moving average and the ADX still greater than 25. And that way we combine all of that stuff onto a daily chart. And then we just play the hourly breakout. The concept behind this thing then looks like this, the concept diagram. That on screen number 1, the higher time frame, there was some major movement or major positive move. Then on the intermediate term or the daily, there's a pullback below the 20-day moving average. And then on the hourly chart, there's evidence of a hourly breakout, which tells you that that might be recovering. And then what we do is we take the previous swing high and we set that as our target for target number 1. And then we say, if that works, that's going to be leg 1, and then we might expect leg 2. But if it just gets up to the previous high and starts to trail and roll over, that's where we might go ahead and just capture our profit. Okay? So that's the idea behind the triple screen concept. Now, let me go back to the daily report. And then what I'll just show you is that the channeling and the overreaction systems, the systems now, are strictly only traded on those ETFs. because that's what we've back tested it on. But now when I go to the Dow, and then when I go over to the ETF 30, what we do is we run those same rules for all of these symbols, not just those ETFs. And then on the next page, when we look at the ETF 30, we run it on more of them, just so, because a lot of guys like those so much that they decided to trade that as a strategy and then do some trade framing. So if the channeling fires, then you get a green light here, like if those two rules, and right now Disney fires because it's greater than its 200-day moving average and it's oversold on a 10-day basis. So it's the only one that fires. If they fire overreaction long or short, then this would fire as a green box or a red box. And then the washout pattern, the 5DD, here's a 5DD. This is Boeing, is down 5 days in a row. So it's a 5DD. Nothing fired on the triple screen. 551W, Disney, fires. It's both a channeling and a 551W. Check or hold. So this little section of the daily report tells you which of those Dow large cap symbols fired on any of those mechanical systems. And then similarly, on the ETF, whoops. The ETFs gives you the same indications. Channeling, overreaction long and short, washout, 5DD, triple screen, 551W. So those are the 6 mechanical systems. And then if you need a refresher on those, because all of those signals are up there, is channeling, overreaction, washout, 5DD, triple screen, 551W. Now these other ones, max pain range compression, and the auto framer, those are strategies, which you've heard me talk about before. And then I also measure to see if they're in a doji. But for these mechanical signals, what I do is I run them every day, and then I report it on here as a way to look up and frame those. Okay. All right. That's everything I wanted to cover for tonight, was just to review those 6 mechanical signals, mechanical strategies, I should say, symbols, systems. And the full write-up in words are in the foundations course on the downloadable resources page. Okay. Any
you.
questions? Okay. All right, fellas, that's everything I got for tonight. Have a good day. We'll be ready to get them tomorrow. And that market extremely stretched. Now, because it's so stretched, because the Z scores are so high, I'm really not interested in a lot of swing trading. What I am interested in is intraday trading while it's moving in my favor, but I do not like holding overnight when this thing is stretched so thinly. That has me a bit concerned. So this is a case where that market condition might actually override my decisions to trade some of these as systems. Okay. All right, that's everything I got for tonight. You guys take care. I'll get this posted into the course. Take good care.
Thank you. Good night.